Welcome back to the California Conversation. I'm Tess Abraham. Governor Gavin Newsom is siding with Republicans for once and is actually opposing the more radical wing of the Democrat Party. What magical issue could be bringing about such a situation? Well, California is pursuing a very aggressive tax policy and trying to get it on the 2026 ballot. What is this policy and what would the implications be for California? I'm breaking it all down for you today. But before we get started, make sure to like this video, subscribe to this channel if you haven't already, and ring that notification bell so that you stay up to date on all things California politics. And if you want more information or you want sources cited in compiling today's episode, then you should check out the corresponding article on my website, which is linked below. All right, so we have another completely crazy tax proposal that we need to discuss today. And as I mentioned, it is so bad that our own governor is even opposed to it. What is going on? Well, essentially, there is a ballot initiative that people are trying to get on the 2026 November ballots to bring before voters. And that initiative is called the Billionaire Tax Act. What this is looking to do is it is looking to impose a wealth tax on all billionaires who have lived in California from January 1st of this year, 2026, at the time that it is implemented, likely in 2027. The actual text of the initiative reads, billionaires living in California on January 1st would have to pay a one-time state tax equal to 5% of their net worth. The tax would be due in 2027. Real estate, pensions, and retirement accounts would be excluded from the tax. And basically, this is not guaranteed yet to be on the ballot. It's in the process of having been proposed, and now it's trying to get enough signatures. And so if enough people sign that say we want this on the ballot, then we will see this as a proposition that we will have to talk even more about and eventually vote on. And then if it was passed, it would be enacted in California. But as of today, it's still in that signature raising process. Now, to really understand what's going on here, we need to first back up and define some of our terms because it's a little bit unfamiliar of what this kind of tax is and then what it would do in our state. So let's just start with the wealth tax. What is a wealth tax? Essentially, this is when a government taxes certain individuals based on the value of their net worth rather than just their annual income. And so we're very familiar with the income tax. We are all subject to that year over year, but a wealth tax looks at the overall net worth of a person. Now, what is net worth? This is an accounting term, and so we are back into my original expertise space. I'm going to put my accounting hat on and explain some of these terms for you. Net worth means assets minus liabilities. So an asset is something that you have ownership in. And so the main asset that you probably have is cash in your checking or savings accounts. And then you might have invested some of that cash into things like stocks or bonds or other investments. And then on top of that, you probably own other things, like if you own a house. A house is an asset. It's something that you have put your own money into. Now, obviously, some of these assets are more liquid. So if you have cash in the bank, you could pull that out today. You can make a purchase with it. If you have cash in stocks, then you would have to sell your stocks to actually see any income from that. So they're a little bit less liquid, but still fairly easy to sell. And then obviously, real estate is pretty illiquid. It would be hard to just sell your house today to get the cash. And so assets can be anything from, again, that cash that you could use today to other forms of interest, even things like business ownership or other investment accounts that would be very illiquid and that don't give you cash today. So those are your assets. So when looking at what your net worth is, you start by adding all of those things up. But to get an accurate picture of how much you actually own, you have to subtract out what you owe or your liabilities. And so that would be something like a mortgage. It would be if you have any other loans, if you have any debt. Because if you were going to completely liquidate everything today, you wouldn't just be able to get cash money for everything you own. You'd also have to pay off all of those debts. And so if you take your assets and you subtract out your liabilities, that is what gives you your net worth. And that is the total number that California would be leveraging this tax upon. So that's a wealth tax. Now, how is this different from an income tax? Like I said, we're all familiar with this. Year over year, you make money. You probably make it from some type of salary or some type of pay that you make at your job. But there are other ways that you can be making income as well. If you own a business, then you are bringing in income that way. And so the money that you make within a year, we know that we have to submit to the government and then we have to pay taxes on that. That's the income tax. However, a wealth tax does not care about what you made in a year or what you lost in a year. It just looks at your overall net worth, and then it's going to take 5% of that. Now, the real key difference is that an income tax is based on realized income. So that is activities that have actually turned into money. So like I said, you work, you get paid, you see that money hit your bank account. And so you now have that money. And even if you pour it into stocks or you pour it into a house, you have actually made something this year. And so that is what the government is taxing you on. A wealth tax does not look at just realized value. It instead looks at assets, whether or not, regardless of if they have actually made you money. And so you could already own a stock portfolio, and that stock portfolio could have increased, which means that your net worth increased because you technically own those stocks. But like we mentioned, stocks are not immediately liquid. So if you own a stock and the price goes up, you're really happy because you're thinking, if I sell this or when I sell this down the line, I will make money, I will not lose money. But you haven't sold it yet. So you haven't actually seen an increase in your income. That income has not been realized. A wealth tax does not care about if income has been realized or not. It only looks at the value of everything that you currently hold, regardless of if it is liquid. And so you would be taxed on the total value of all of those assets that you hold, again, regardless of if that actually has translated to cash in your bank account today for you to be able to pay on the value of the wealth tax, which creates a whole host of problems that we are going to get into in a minute. But it's first important to understand, why is this being proposed this year? Why is California trying to break into this wealth tax territory right now? What's going on? Basically, this is being proposed by healthcare advocates, and it is being supported by healthcare labor unions. And so the revenue from a wealth tax would go toward funding healthcare, public education, food assistance programs, and all of these things are being done in light of federal funding cuts. But it mostly hones in on that healthcare funding. So 90% of revenue, it is stipulated in the proposition, would be going toward healthcare costs and expenses, because again, those have been cut by federal funding this year. Now, it is no surprise that when we look at who is supporting this proposition, it is not just exclusive to people in California or California legislators. It's anybody who really likes to tax the rich. And who likes to tax the rich more than Bernie Sanders? I don't think any human being has existed who wants to tax the rich more than that guy. So to no surprise, he is incredibly supportive of this proposition, and he has spoken out in favor of it. And he's even come to Los Angeles and gave a speech just last week where he compared California's highest earners in our state to the oligarchs and the monarchs of past centuries, which is just a wild comparison. But no less, he said that America's billionaire elite class, quote, no longer sees itself as a part of American society. And so, of course, he has railed against this idea that there are billionaires and millionaires and just wealthy people, and that they actually are taking money away from lower class, from lower income and middle class workers. And so they need to pay their fair share by paying far more in taxes than everybody else. And so, of course, he, again, is very supportive of this wealth tax. But this has caused quite the division in the Democratic Party, because even though Bernie Sanders and others support a measure like a wealth tax, Governor Gavin Newsom does not. And Newsom largely argues that the tax would destabilize the budget, and it would do so by driving wealthy residents and businesses out of California. And we will get into that statement in a little bit. But it's also important to understand that Governor Newsom obviously has presidential aspirations very soon, and it would probably be a very bad look for him if his state imposes a wealth tax under his watch, under his last year as governor, right before he goes on to try to rally more people to vote him into presidential office. So his motives are a bit split there because Newsom is no stranger to taxes. He loves taxes. He loves increasing taxes. We feel the tax burden here in California. I've talked about that. I don't need to continue hammering that point. So I definitely don't think he's ideologically opposed to a wealth tax, but he knows that he needs the support of big business owners. He knows that he cannot anger some of these people who are the heads of innovation in his own state, especially if he's trying to gain their support in a presidential run. And speaking of those people, his fears are not unfounded because California's billionaires are threatening to leave California, or they already have solid plans to leave California if this wealth tax goes into effect. And so people like venture capitalist Peter Thiel, Google co-founders Larry Page and Sergey Brin, Meta CEO Mark Zuckerberg, and several others have been actively outspoken against the measure and have even fundraised against the measure because obviously they are the people who would be the most affected by this. And so they are threatening to leave what is the tech hub of our nation here in California, in San Francisco, in the Bay Area, in Silicon Valley. That's what California is known for. And so all of these people are threatening to move away from California because of this kind of tax that might go into effect. And it's not just the people who would be most impacted by this. Even economists are in opposition to this form of tax structure in the state. And so there's been a warning from several leading economists that this would just be disastrous for the state of California and that we should not be pursuing this. And one of the more funny ones who's outspoken against it is Mr. Wonderful, Kevin O'Leary from Shark Tank. If you have seen that show, he is blasting this type of proposition as just pure bad management. And he's encouraging California voters to vote in different leaders who would not even consider this type of proposition and who would not support it passing as legislation in our state. So if you look at it, people who know about money and people who actually have made money for themselves, obviously, but also for others who have created jobs, who have very successful companies that have contributed to our state and to our country as a whole, all of those people are very outspoken against this bill. So it's created quite a debate here in California. So who is right? Would this type of proposition actually raise money for the healthcare system here in California? Would it be disastrous for our state? What would the implications of a wealth tax really be for California and Californians? It's very important that we dive into that. The first implication of a wealth tax would very obviously be wealth migration. This is what I mentioned, that billionaires and wealthy people would leave the state of California in order to evade or avoid these types of taxes being leveraged on them. And really, I can't blame you for that. I completely understand that. If you have built a very successful company and you have become very wealthy off of that, why would you want to hand over a percentage of your net worth? Again, something that you have built, something that you have to maintain. Why would you want to hand that over to the California government, which is incredibly wasteful with its money? And specifically, you want to hand it over so that it could go toward healthcare funding, which is always underfunded and completely overspent. I would move too. I actually completely see that. The main example of this is Mark Zuckerberg of Meta. He has plans to move to Miami, Florida. It looks like in April. He is currently in the process of buying a large mansion or estate out there in a very similar area as many other very wealthy innovators and business leaders live. And so it's looking not like he's buying a vacation home, but like he actually has solid plans to leave the state and move to California, and move to Florida. And he's been very outspoken about that. And then South Florida real estates are reporting that they have had an influx, especially in the new year, of clients, of people who are trying to move specifically out of California. And so we're already seeing these trends that either people already are moving, they have moved, or they have plans and are threatening to move if things get far too expensive for them here in the state. But this kind of migration would be completely detrimental to our economy. And it's important to understand that because California's budget is already volatile as it is. But the reason that it's volatile, it is largely dependent on the income tax as well as capital gains tax revenue from its wealthiest residents. So the taxes that you and I are paying on a regular basis, of course, contribute toward the revenue base, but really California relies on its wealthy residents because it has a very progressive tax structure. And so that is where it's getting its income from. If those people leave the state, then that means year over year, they would see quite a drastic loss in tax revenue. And so while it might get a one-time gain, it might raise a couple $2 billion from an initiative like this, like a wealth tax, in future years, as years go on, and that one-time gain fades because they will spend it immediately, then they are going to lose money from the people who have moved. And so they're not going to get income taxes on Mark Zuckerberg's income or on his capital gains, on his investments, and so many others who would also move. That's a really heavy loss for California. And then if California is not getting enough income to fund its massive budget, the tax burden is going to further shift onto low income and middle class earners just in future years, because a bulk of the spending is not on the wealthy people. A bulk of our state's budget, when you look at our expenses, is actually on welfare, and it's on social services and programs that are largely funded by wealthier people than the people who are actually using the services. And so if the wealthy people move, you still have to fund all of the services because they didn't take the services with them. And so that means they're going to raise taxes on those of us who remain, which would be more middle class or just average citizens. That leads to the second implication which follows, which would be investment slowdown. So if you think of who would actually want to invest in businesses here in California, you realize it's wealthy people. Who has money to just throw into a company, to take a risk, to try to see some sort of return? Wealthy people. If you start a business, you often need investment because you do not have the money in order to fund the type of research and development or the type of capital expenses or the startup costs. You personally don't have the money to just pour into that. If you did, you'd already be a wealthy person. And so, yeah, you could do whatever you want and start a business. But most people are not in that position. And so when you start a business or you have a startup or a tech company or any of the things that we've seen contribute to California's economy, you need investors. You need people who are going to say, I will give you this money and I will try to help your company be successful. And in return, I will see part of the profit and earn my money back. The only people who can do that are very wealthy people. And so what we see is actually the beauty of capitalism and of investment. We see that people with money like to invest in other people who are also trying to make money. And so it just lifts everybody up. It continues to drive forward innovation. It brings in new companies, which brings in new revenue, which brings in new workers, and it really boosts and supports the economy. Investment is a very good thing. And we see this tangibly in statistics about California. Startups in California raised roughly 62% of all United States venture capital dollars in 2025. That's insane. One state raised more than half, well more than half, 62% of all startup venture capitalist money in the entire country. That's crazy. We are clearly dominant when it comes to being a startup hub. But that's not all. California is also home to the most Fortune 500 companies of any state, with a whopping 58 companies listed on the list as of 2025. And these include major global names like Apple, like Google, Meta, Chevron, Wells Fargo, Netflix, Visa, and PayPal. Those are all home in California. And additionally, as if that wasn't enough, California hosts 33 of the world's 50 leading artificial intelligence companies. So it's not just that California has a bunch of businesses or a bunch of successful businesses. We also are the heartbeat of innovation. AI is driving forward so much change in our state, in our country, around the world. It is changing the workforce. It is the cutting edge of what is newest in innovation these days. And 33 out of 50 of the leading companies are here in California. Those statistics are incredible. I am incredibly proud of our state for being home to a lot of those companies and a lot of the people who invest in those companies. But now you see the problem. We need investors. We need people who are going to be able to pour capital and money and expertise into these companies to continue growing those statistics and driving forward that innovation. If you migrate out the wealthiest among us, you are going to leave behind people who need investment, people who are richer than them. That's just how it works. The third implication really goes along with the first two, but it is forced asset liquidation. Now, what does this mean? It's just like I explained. A lot of wealthy people in California may not actually have in cash their net worth. So a lot of it is built off of business ownership. A lot of it is built off of stock portfolios. Now, according to the proposition, real estate would not qualify, so we don't have to worry about real estate. But again, there might be several assets that are not actually in liquid form. And so some may be forced to sell off some of their assets in order to pay for the tax. So let's take, for example, let's say that someone who lives in California has a $1.5 billion in total net worth. And so they then would qualify to have to pay the wealth tax. But let's say that most of their wealth is tied up in the stock of a company that they founded. This would not be uncommon. This would actually be a very feasible situation, especially again, as a state that has so many businesses and business owners. Now, under a 5% one-time wealth tax, they would owe $75 million because that's 5% of $1.5 billion. But the problem is they might not have $75 million just sitting in cash in their bank account. I would wager they probably didn't, especially if a lot of that net worth is tied up in their business. And so they would likely have to pay off sell off some of their company shares in order to actually realize a lot of that income. This, in effect, would reduce ownership in their company. It might also have a negative downward pressure effect on the stock price of their company. It would trigger additional gains taxes on the shares that were sold, and ultimately just not be very attractive to a very successful business person because it would be affecting their business, it would be affecting their wealth, it would really be changing their lives. And so it's just important for us to understand this is not like saying, oh, you just take the money that you have in your account and you pay it off. Some incredibly wealthy people might be able to do that, but other people who have been successful in their businesses or companies might not have the 5% just sitting in cash that they want to hand over to the government. And so this further ties back into the first implication of a wealth tax, which says that if this is going to so negatively affect people who are living here who are successful, then of course they're going to move because they do not want to have to liquidate their assets in order to pay the government a wealth tax. And the fourth implication is very important because it's legal and constitutional questions that are inevitably going to arise. Now, the government does have very broad powers to levy taxes on its citizens. That is true, but it does not have completely unchecked and just wild abilities to put any sort of tax in place. And so there are both federal and state implications. In our federal constitution, it says that states cannot unduly burden interstate commerce and that there must be a connection between the state and the taxpayer. This is known as the Dormant Commerce Clause. And so a lot of problems or questions arise when it comes to wealth that was earned outside of California or wealth that currently part of their net worth is tied up in assets that are not in our state? Or what about people who move to a different state? Because this type of tax is looking backwards. People who had lived in California starting January 1st of 2026. Well, if you have moved, now they don't have a connection to the state anymore. And so how much can the state actually levy a tax on them? So it's a lot of questions about what jurisdiction California has over someone's net worth. Just because someone is worth money doesn't mean that it's all made in California or that it's all owed to California. It could be spread across multiple states. And then again, we have the question of people moving. So there are federal constitutional questions. And then on top of that, in our state constitution, there are further questions. One question is tax uniformity. There has to be some type of uniform method to levying taxes. And so while you can have some sort of tax structure like California does, and it is allowed to be progressive, this type of tax is extremely narrow and very punitive. And it can be argued that it just seems very arbitrary that you're leveraging a tax on people with a certain amount of net worth. You've just arbitrarily decided that's $1 billion. But what happens tomorrow when you decide it's going to be someone with $1 million? It could change very quickly, and then more people could be affected. And so there's just questions for that kind of uniformity. Additionally, there are retroactivity concerns. So I briefly mentioned this, but these are backward-looking taxes. The measure's not even in effect yet. If it went into effect, it would be for 2027. And it would go into effect saying, okay, so everybody who is a billionaire starting on January 1st of 2026 must pay taxes. Well, those people didn't even know that that was going to be up for a vote this year. And so can it actually take effect, or would it have to be forward-looking? Like if it's enacted in 2027, going forward, starting in 2028 is when we would leverage a wealth tax. Questions like that. So there aren't just the practical questions. There aren't just the questions of the economy, although all of those are incredibly important. There's also just questions of, is this even legal? And will this end up just getting tied up in court, which is more waste of time and money and judicial effort. Now, really, there are so many other implications that we could look at of a wealth tax. And if this does end up being a proposition that lands on our ballot, we are going to have to talk more about it because there's just more to be said. But above all of this, outside of all of these reasons, there's really one main reason that this is a bad idea that we should all be looking at and that we should be informed on. And really, that is because it is simply wrong and unfair. We should not promote an idea in our society that says that if you accumulate wealth or if you earn income, that then you are going to be punished by your government for being successful. Here's the thing. We should be incentivizing people. We should be helping to promote people to go out and find success for themselves, to contribute to society, to contribute to their economy, and to try to promote what is good, not just for themselves, but for others. And in that, when promoting what is good for others, there's inevitably going to be some sort of self-interest. That's an entire philosophical idea that actually promotes our type of economy. And so we should be trying to champion more people to start businesses, to pursue the American dream, to use the freedoms that they've been afforded in America to build the kind of life that they want to. We should not be promoting the idea that if certain people are wealthy, that we should just redistribute that wealth because it's unfair that someone has more money than you. No, it might feel unfair. You might feel like, I want millions of dollars. I want to be set for life. But we should again be encouraging, how can you get to a sustainable future for yourself and your family? Not all of us are going to be billionaires, but how can you be successful today in your life? And then how can you be content in those circumstances? Those are very important questions. And those are things that we should, again, be able to do as citizens of our society because our government protects our freedoms and enables us to be able to pursue those things. It is wrong of Bernie Sanders. It is wrong of anyone else who promotes this idea to try to say that wealthy people are a net negative thing to our society. That's just not true, because I think we could all agree that when you look at companies like Google and Apple and even Tesla, that those have contributed positively, not just to California, not just to the United States, but on a global scale. They have been world-shattering innovations. And that's because innovation is what drives forward civilization. When you innovate, when you bring on new technology, when you bring on new advancements that are more than just the tech world, but also extend over into healthcare, that extend into all spheres of life, that is the basis for then making everyone's lives better. And so wealthy people are not holding you back. Money is not just a fixed amount that then if some people take more, that means other people are going to inevitably get less. That's not true. When we start to innovate, when we start to change society and contribute to society, that actually lifts everyone else up. And we see this in America because the standard of living and the actual average overall wealth for everyone here in the United States is much higher than other places in the world. And so we see that by innovating and by having business and by having money and wealth, that it actually helps everyone else. It helps low income. It helps middle class workers. It does not hurt them. To hurt them would be to say that once you are successful or once you have contributed, that now we're just going to arbitrarily take that money and distribute it to people who did not earn it. This does not mean that there won't be inequality. It does not mean that our system is perfect. Obviously, there are unequal outcomes. And obviously, there are poorer people who we would agree that charity groups, that churches, that community-based organizations should be reaching out to help, because if we have been given much, we should also turn around and give much. And so that's why those kinds of organizations exist. So it's not to say that there's not inequality, but it is to say that a free economy depends wholeheartedly on the principle that individuals can strive, that they can take risks, and that they can build something extraordinary without fearing that their very success is going to become a liability to them. But a wealth tax takes away that principle. So for California, the goal should not be to pull down the people who are at the top of the wealth or income scale. It instead should be trying to raise up those who are at the bottom. And it does this by expanding opportunities. It does this by creating an environment where innovation, where hard work, where creativity, and where entrepreneurship are rewarded and not punished. Bottom line, a wealth tax is a terrible idea. We should oppose it as it moves through the legislative process. I genuinely hope this does not end up on the ballot. And if it does, again, we are going to be talking more about it, because it is very important for us to understand the principles of basic economics. But more than that, to understand what taxes are for, to understand what the government is for, and to understand, again, that our principles of our very country, of our very founding, are rooted in people being able to change their social status and people being able to make better and different lives for themselves. But we cannot do that if we are going to punish you once you've been successful. Because ultimately, the American promise has never been that there will be equal outcomes. The American promise is that the opportunity is open and available. And if California wants to continue to drive forward as a place of innovation and a place of possibility, then that principle must remain at the center of all of our policies. Thank you so much for joining me here today. I hope it was helpful for you as you navigate life in our state and that you even learned something new. If you love this show, please spread the word and share it with your friends, family, and fellow Californians. And I'll see you back here next week for another episode of The California Conversation.